thinking about leaving Canada and never paying taxes here again? If you don't plan properly, the CRA might still consider you as a resident, forcing you to pay taxes on your worldwide income. But if you follow the right steps, you can make a clean tax exit and ensure you legally pay zero taxes in Canada. If you're from India, I made a very India specific video which you can check. The link will be there in the description. In today's video, I'll take you through everything you need to do before leaving Canada, so you don't get hit with unexpected tax bill later. Plus, I'll share your checklist at end of this video to make this process easy for you. First, let's understand Canadian tax residency. As you see this table, a resident by definition is someone who lives in Canada or has a strong ties. What does it mean? You have a house, spouse, dependent, etc. You have stayed in Canada for 183 days or more in a year. In this case, you report worldwide income and pay Canadian taxes on all your earning. Here you could be factual resident, that is, if you have a strong ties to Canada and live here most of the time, and deemed resident if you stay 183 days plus days but have no strong ties, you may still be taxed as a resident. Now comes second category, non-resident. You're a non-resident for tax purposes if you live outside Canada for more than 183 days in a tax year. You sever significant residential ties, that is home, family, social benefit, etc. You're only taxed on Canadian source of income, that is rental income, business earning. Then comes deemed non-resident of Canada, where the tiebreaker rule applies. That is, if you have a residential ties in both Canada and another country, example US or India, that has a tax treaty, you may be classified as a deemed non-resident. You'll be treated as a non-resident for tax purposes. The tax treaty determines where you pay taxes, usually based on permanent home, center for vital interest, or habitual abode. Now that you have understood this category, let's see how to pay zero taxes as non-resident Canadian citizen. So first, you need to meet this criteria of being a non-resident and then have no Canadian source income. In simple definition, no money coming into from Canada. If you have no employment, rental, business, or investment income in Canada, you won't owe any Canadian taxes. It's as simple as that. Then, if your new country has a tax treaty with Canada, it usually prevents double taxation, giving taxing rights to your new country of residence. For example, you can see here is the document which shows treaty between India and Canada. As a non-resident, you must sever all residential ties, which I talked about just a while ago. So, you must cut all significant residential ties. And to do this, before you leave Canada, sell your Canadian home. If you rent, then you can pay taxes on the Canadian rent. If you have spouse or dependent, they also move out of Canada. If they are in Canada, then you have ties to Canada. Close Canadian bank account and credit card. Some update their status as non-resident by filling form, but any interest which comes to your bank account will attract tax and you will get T5 from the bank. So is the case with brokerages. Some brokerages don't allow you to have an account as non-resident. You will have to cancel credit card and also cancel your driving license and health insurance. Any income that you earn in foreign country as a non-resident will not be taxed in Canada. If you have a TFSA account as a non-resident, you won't be taxed on income or capital gain inside TFSA. However, what is important to note is that you cannot contribute to TFSA while you are a non-resident. These contributions will be subject to penalty. When it comes to Registered Retirement Saving Plan RRSP, if you are a non-resident of Canada, you can still hold RRSP and not be taxed on the income and capital gain within the account as long as the fund remain in RRSP. However, the situation changes when you withdraw from RRSP. If you close the account before you leave Canada, you would have paid tax as part of the departure tax. When it comes to life insurance proceeds, as a non-resident beneficiary are not taxable in Canada, regardless of beneficiary's residency status. This is because life insurance payout are generally not considered taxable income. However, if the life insurance policy has generated income, for example, through an investment component, then the income earned by the policy might be subject to Canadian tax if it is linked to Canadian property or investment. This was for Canadian citizen. Even for someone who is on PR or work permit, CRA taxes you based on residency and not citizenship. So, you'll have to establish whether you are a non-resident, deemed resident, or a factual resident. So, to be considered non-resident, you should severe residential tie, that is, not having a house, your spouse or kid don't remain in Canada. CRA might still consider you as a resident. And closing bank account, credit card, any loan, then comes government ties such as cancelling health card, driving license, and then any social benefit like CCB. Don't make mistake of not informing CRA about you leaving. And then you file departure tax return, which is final tax filing, where you fill T1161 and T1243. Here you will mark your departure date on your tax return. If you have any stock, real estate, taxable income, you may owe departure tax, which is deemed disposition tax, and pay all taxes as you may have capital gains from stock, for example, sold at fair market value before leaving. And file this form NR73. This is optional and helps CRA on confirmation of non-residency. If you have any rental or investment income in Canada, ensure 25% withholding tax is applied before you leave. I have not covered corporation part as not everyone might have this challenge. If you have, then keep a note to speak to your CPA. Once all of this is done and you have done your departure tax, paid all dues, and have become a non-resident, you have freed yourself from Canadian tax like my friend. So, final checklist for zero taxes: severe all residential ties, financial and government ties, sell assets and pay departure tax, close TFSA, RRSP or accept withholding taxes, file final tax return and this form T1164 and T1234, and notify CRA bank and services of your new address. To help you in this journey, I have attached a Canada exit checklist, which you can customize and add things which are relevant and discuss with a specialized CPA on immigration. I hope you found today's video helpful. Do let me know through your comments and don't forget to subscribe, like and share. Thanks for watching Canada Try Industry.